Alfred, welcome.
Thank you. Thank you for having me.
It's always a pleasure to interview Alfred. He is one of the most sincere, genuine, and self-effacing people I know. So, and he has such an impressive track record. He doesn't seek out the press or interviews, but so humble. And so I'm sure you're going to enjoy a lot of his stories about his experience as an entrepreneur, a successful entrepreneur, and an investor. And with just a great track record. I want to start with a story that many of you have probably heard of. I heard it first from Tony Hsieh, his partner in many ventures, and they met at Harvard. Tony sold pizzas. How many people know this story about the pizza and the slice? Okay, well, I've known this story for quite a while, but I didn't really know the story. So I want him to share it again, because when I first heard the story, when Tony told the story about Tony selling pizzas, whole pizzas at Harvard, and Alfred buying the whole pizzas and then selling them by the slice, I thought, wow, this guy's a shrewd businessman. And then when I spoke to Alfred, I finally realized why he was doing it. And I think it gets to the heart of entrepreneurship. You don't do something just to be a shrewd businessman. Yes, you should make money, but he actually started it as a service. So I wanted him to share the real story about the pizza and the slices.
I don't know about whether it's a real story or not. Tony loves sharing this story because that's how we met. He was always an entrepreneurial person, so he decided that in not his senior year, but his upcoming junior year, he was going to buy the rights to the grill in our dorm, and he was going to own it for 2 years. And then that's the only way that he could capitalize the cost of having a pizza oven in our dorm, because most of the grill, they just served hamburgers or fries and milkshakes, which wasn't really high margin. And he was always very entrepreneurial and had this concept of selling pizzas. And I had a large college rooming group, so I went downstairs and bought pizza from him every single day, and I would just get a discount because I bought it every single day, and I would buy pies, 1 or 2 pies every single day. And I would bring it upstairs, and the pizza per slice downstairs was $2. He gave me a discount, so it's probably $1.50 or $1.25. Per slice, and I asked my roommates for $1.50 or $1.25 back, and I would always get $2. And I was like curious why this was happening, and I found out later that, oh, the quarters were too important of a commodity for them to give up their quarters. And it's an interesting lesson, because in college, quarters were a prized commodity because we needed them for washing machines, drying machines, vending machines, arcade games, and people did want to go walk in the cold to the bank and get quarters and bring them home and then giving them away. So it was an interesting business lesson that even a commodity like a quarter can be valued more than a quarter, which is what happened.
And he started a service, then he ended up making 50 cents a pizza per slice. So.
And then Tony was very upset that we calculated how much we made per hour, and I technically made more than him per hour, and he was doing all this hard work, and I'm like, come on, you made more money at the grill than I did, because all I did was every night go downstairs and pick up a pie and bring it upstairs.
But from there grew this amazing friendship, because you've done a lot with Tony, and you started Venture Frags in 1999. And that was, you and I spoke earlier, and you said, when I asked you, like, how was that starting a venture firm right in 1999, a year before the bubble burst? And you told me that was the worst time ever to start a venture fund. And I want to ask you a question again, whether now is not such a good time to start a venture fund. The audience heard earlier, First Republic Bank had a report out that said 300 venture firms or institutional funds have emerged since 2009 to invest in the early stages. But now the market is a little frothy. We're not seeing too much, there's a bit of lack of discipline in the market. So is now a good time to start a venture fund?
I think if you're starting anything, whether it's a venture fund or a seed fund or a company, if you're thinking about doing it for the long term, really doesn't matter. Is this the best time to start a fund? I don't know, probably not, because valuations are high. But that doesn't matter if you're going for the long term. And I think I've learned to sort of think about not 1 or 2 years or a moment in time. If you're building something enduring and it's going to last decades or generations, you're going to face lots of ups and downs anyway, and you might as well just start running today as opposed to kicking the can down the road, it only gets more competitive. It never gets less competitive in this world. So in some ways, in the macro sense, is this the best time in this 1 or 2 year period? Maybe it's not the best time, but if you're going to wait 3 or 4 or 5 years, it's still going to be more competitive 3 or 4 or 5 years down the line than it is today, in my opinion.
Yeah, it was definitely competitive. I remember last year on this stage, Peter Thiel, I asked him whether seed stage investing was harder or easier since he had invested in Facebook in 2004. And he said it was actually harder because it was so competitive now with so much of this new capital. And yet if you talk to Josh Koppelman, he will say that it's actually easier because a lot of the startups are, have far more traction. And you and I have talked before, and you said, well, there's a lot more opportunity. So is it harder or easier than when you first started seed stage investing over 10 years ago?
It's both. I think it's the best of times and the worst of times, and I think that you can't play the same game you played in 1999 or 2000 or 2001, 2002. I think the game is just different. So if you're trying to intuitively figure out something, whether it's a market is going to take off or a product is going to take off, that doesn't work because back then there might be only 5 or 10 or 15 companies that you can see, and you can see all of them, you can play with all the products. Today, there's probably 5 or 10 or 15 of them being produced in a day. The scope of innovation is much broader, so you can't do the same thing you used to do. Mm-hmm. You have to be smarter about it, and you have to use different tools. Back then, was there any measurement ability for companies to figure out whether you were having great traction? No. Today, you have App Annie. You can go look up how you have public rankings, and you can go into App Annie to get even more detailed about how well the app is doing, whether it's downloads or engagement. There's just a lot more information that you can absorb, that you can use into your decision making, and so. Does that make it harder? In some ways, it makes it harder, but the access to that information is easier. I'd also point out that back then, there were maybe, millions of people that were on the internet. Today, you have billions of people, and so that makes a huge difference. And it also allows you to be wrong every now and then and still get to a soft landing, as opposed to back then, I think, if it didn't work, it probably just crashed and burned.
Yeah, it's harder now because you have a lot more competitors. I mean, you're investing in one company, and 5 other VCs are investing in the same company, a different company, but in the same industry. And so that requires you to then potentially put in more money into that company so they can compete with the other companies. I mean, do you feel that seems to make it a lot harder, regardless of the opportunities and all of the transparency that you have?
Well, I think you should ask people who have been in this business for long periods of time, and they probably would all say every year, every decade, the amount of money back then seemed like an incredible amount of money being invested at that time. And I think that's been true, for the last, 20 years, whether I was an entrepreneur or as an investor. And you could thank the Fed for that, right? The Fed has kept interest rates over the last 2 decades at clearly close to 0. So can't really make money in the bond market, so therefore people who used to invest in bonds invest in corporate bonds, and then because the corporate bonds don't have to pay as much because the risk-free bonds, the government bonds don't pay as much, the corporate bond people now invest in stocks. The people who invest in stocks invest in the growth rounds at the private rounds. And the growth investors invest all the way to Series B companies that are just getting some good level of traction and trying to pick them off because they feel like that's where you can make money as a growth investor. And then the traditional venture investors are going down all the way to the seed level. And so I think it's always been hard when you see that happen, it's always been hard, and it's going to continue. Good thing is, I think there's a bit more rationality today. The Fed is about to raise interest rates. Many predict that next year they're going to raise interest rates once a quarter, and basically interest rates will go back to some level of norm, and there'll be less money chasing chasing all the way down the spectrum. And so there'll be some level of normalization. That's a good news and a bad news at the same time, and I think it's also going to bring a little bit more rationality. The good news about this is that there's no catalyst in the system that will cause a financial meltdown, not like 2008, 2009.
I want to talk about I didn't want to talk about valuations and bubbles at this point, but you just mentioned something. So Mark Cuban does say that he thinks this time is actually worse than 1999 and 2000 because now the valuations are, the frothiness is happening in the private markets where there's no liquidity at all. So he actually thinks there's going to be a bigger downturn.
I don't agree with that because I think the people who are investing in these companies, most of them have long-term views, and they're willing to invest for long periods of time. And I'll speak for Sequoia, I can't speak for everyone, but our LPs are foundations and charities and institutions that are trying to survive in perpetuity. Mm-hmm. They have a very long view on when they need to get a return. And so long as that's true, I think the institutional investor doesn't need to rush to an exit.
You don't need to get out.
We don't need to get out. The institutional investors don't need to get out. The individual investors, do they need to get out? I think they're seeing some level of liquidity with secondaries. Mm-hmm. So, some of these companies that have these what are called unicorn or unicorn valuations, some of that comes with a secondary where they buy out early investors and early shareholders. And to that level, that's not going public, but it's kind of like going public.
Yeah, of course.
So there is liquidity. We just don't measure it that way. We don't see a company go in the past, you see a company going public and that's liquidity. You see them being sold and that's liquidity. I think it would be interesting to see how much secondary has actually flowed back to early shareholders and early employees of some of these companies.
So I want to talk about most of the investors here, again, seed to early stage investors, a lot of them trying to figure out what their early stage investment strategy is. And one of the things that we've been seeing a lot of is because you're saying a lot of these traditional VCs are now also investing a lot in seed. There's 300 new venture funds that have formed, some of them going to seed, post-seed, and what the result has been this increased proliferation of this strategy of option buying, right? Not really knowing, not really doing your due diligence, following on with someone, with a friend or so, but what is the upside and downside to that? I mean, the upside is great. Some of these entrepreneurs get funded, but what are the upside and the downside to all of this option buying that everyone's doing?
I think the negative way to paint that is either you call it option buying, or because you just don't know and therefore you want to buy all the sort of companies in this. You think this category is interesting. I don't know which one of these companies will succeed. I'm going to invest a little bit in all of them, and then the next round I'll invest in the next round. That's the option buying idea. There's no guarantee that you get to invest in the next round. That's the only question. And I think that's the negative side. If you're option buying, it's much better to pick, in my opinion, if you have a long tail, a parallel distribution, it's much better to pick. And even if you have to pick a little later, you get the right one, because most of them are going to fail. So if you believe the parallel distribution will continue to exist in venture, then I don't think the option buying or more negatively spraying and praying methodology works. On the flip side, if you believe that the market in technology investing is mature and you still don't know which one it is, then there is a lot of theory in just creating an index. And creating an index have worked in the public markets. And the question is, will it work in the private markets? I think it will if the distribution is not as parallel distributed as it has been in the past. And that's a debate that people can have. We at Sequoia still believe that it's going to be a parallel distribution, and we like to pick, even if it's a seed. Our partnership, each partner makes on average 1 to 2 investments per year, and some years it's 0, and some years it could be 3 or 4 per partner. And the reason for that is we believe in trying to really understand the market, get to know the people that we invest in, and then pick.
Yeah, and I think that I like the way you put that, by the way. I think that's going to be a new euphemism. It's not diversification. We're creating an index fund. It's a good way to look at that investment strategy in that way. But you mentioned that if you don't lead a seed, you do seed, you do about 3 to 6, as you said. But if you don't lead a seed, you'll do Series A, 1 or 2 a year. And some of the companies out there who do pull these funds together without a lead, with just, hey, we raised $2 million with, half a dozen people throwing in $250,000. It's a bad signaling sign for you, even though, to me, it sounds like they're being scrappy. They're trying to raise money. Sure, they weren't able to get a lead, but they were able to get a syndicate together. But for you, why isn't that scrappy? Why do you think that's a bad sign and something you wouldn't actually look at?
Well, I think it's not a good or bad, black or white kind of thing. It's nuanced. If you believe the market is well capitalized and you can get money from lots of people, then you should pick the people that are going to bring you the most value. Mm-hmm. And then you want to give them enough ownership in the company that allows them to want to work or on your behalf. And so we kind of think of it as an interesting play. If they're only investing 100 or 200,000 out of a fund that's 100 million, that's not going to really move the needle. If it's 100 or 200,000 and the person's net worth is $1 million or $2 million, that's a big statement. So I don't really have a judgment on the 100,000 or 200,000. I have a judgment on whether someone really is going to make an impactful sort of contribution to my company if I were the one raising the money.
Right. So when you do a seed round, you actually take the majority. Well, I mean, you take a big stake in the company. You would never go in and around, and you basically want to lead those seed rounds.
We generally, if we are interested in making a seed investment, we generally like to lead the round or partner with someone. It probably would take $1 to $2 million of the round.
So I want to talk about the seed rounds and what it takes to get the round as well as a Series A, because how many people here are trying to raise a Series A?
Fair number of people.
Fair number. So when you raised money for Link Exchange, I don't remember when that was, 15 years ago or so, you raised, for your Series A, it was $2.75 million you raised for a Series A. And today, that $2.75 million would be basically a seed round. So regardless of what we name it, what kind of proof points did you need to get to get $3 million then? What does it take today? What kind of proof points does a startup need to raise a $3 million today?
Yeah, the sort of change from what's an A today versus what's an A back then, or what's a seed back then. And so we had Link Exchange started with a $100,000 seed. It was from a friend and a family member, and we had to figure out how to build out data centers in a co-location facility. This is not like AWS time where you could just go, so we had to build a data center. And so it was quite interesting that today's seeds are anywhere between $1 to $4 million, and Series A's are
up to 25 million.
10, 15. One of my partners called that vanity sizing in the venture business. And so I think the proof points are pretty much the same as it was back then. For investing in a Series A, we're looking for, we're looking for founders that are rare breed. They're creative spirits. They're the underdog. They're the resolute. They're independent thinking. It's on our website what we look for. Another way to summarize it is they're relentless. They just don't give up. They have unique insight into their market and why the world should be different and why they can win. And the way they've gotten to that unique insight is to
keep asking why. Why has this industry been created this way, and where are all the assumptions that don't make sense anymore? And finally, you know, they're just people that sort of want to sort of change the world. So that's on the founder side. On the market, most venture capitalists will tell you that they're looking for a large market, which is always true. We're always looking for a large market. I think the concept of the market is more nuanced than that. Just like the sort of what we find to be a great founder is more nuanced than, you know, you're unstoppable. And the sort of nuances are no market is perfect, but we would like a large, growing, non-competitive market, and those are not always going to be the same, so it's very nuanced. Are you in a large market but it's not growing anymore? Are you in a large market but it's hyper-competitive? Are you in a smaller market but it's growing really quickly and there's no competition? Are you in a market where the trends are favoring your company versus the incumbent because of the changes in technology or the changes in a business model or changes in a service? And so there's a whole nuance to our sort of understanding of the market. We're looking for a product or service that customers and clients really love, and they're willing to pay for.
Does that mean that they have to have revenue? I mean, you're doing $4 million to $25 million in Series A rounds. You're writing out checks as little as $4 million, probably not, you know, probably on average $10 to $15 million. You talked about sort of the traits that an entrepreneur needs, the market size, it has to be quite large, but what about the traction? I mean, where do they have to be? Do they have to be generating revenue? Do they have to have a certain number of customers?
You don't have to have any specific number. I think if you're on the enterprise side, you certainly need to have some pilots and some ability to show that those pilots have converted. So that's much more important on the enterprise side. On the consumer side, obviously, there's lots of freemium models, and you can show you don't have to show a lot of revenue. You can show a lot of users and a interesting conversion rate to paid, and the number of paid may still be small. And all the way to companies that have great traction, great retention, but no monetization. I think the challenging part of building an app today is that it's very, very hard to get into the top 100 apps. And so you're going to have to figure out how to do that. And so
do they have to be, if you're investing in an app company, do they have to be in the top 100?
They don't have to be top 100 when we invest. The dream is that they are an important application today, mobile application today. So yeah, the dream would be that they're going to be the top 1 to 50.
You, at Sequoia, you guys looked at Uber for their Series A. They certainly had an entrepreneur with a lot of conviction and personality and a big market. Why did you guys say no?
Yeah, that was a big failure on our part. Seriously. I think sometimes we were too smart for our own good. And that's an example of being too smart for our own good. I think we sort of looked at the market. First of all, we looked at the service and we loved it. So it was a product and service that we really like. We looked at the entrepreneur, and he's obviously a relentless, original thinker. What we got stuck on was the market, and the original pitch in the Series A was that it was going to be a black car service. We did not dream with Travis and what we call dreaming with the founder on what this could be. And I think if we had dreamed with him that this could transform transportation, I think we would have gotten there more easily than thinking that it was going to be a black car service.
Was he trying to get you to dream and think bigger, and you guys just kept thinking black car, or was he talking black car, and maybe both sides should have had a bigger vision, and his vision came after his Series A?
I don't know. It's 5 years ago. Both sides probably rewrite history to some degree. But we left thinking that it was going to be a black car service, and it was going to be very hard to get into taxi. He probably said, I'm going to go into black car because it was unregulated and taxi's regulated, and we'll eventually figure out the taxi. He didn't have a solution like UberX at the time, or even talking about it to the degree that he had. But he certainly was thinking broader than the black car service. Well,
you're an investor personally in Uber. You invested $30,000 You clearly had the vision, but as you said correctly and rightly so, that it's easier to write a $30,000 check than it is to write several $1 million, and you have to have a lot more conviction at that point. But Peter Thiel was on the stage last year, and he's an investor in Lyft. He disclosed that, but he definitely he felt that Uber was overvalued at the time. I guess it was $40 billion. And so you're an investor. I'm sure you're a big fan. Explain to us here why Uber. What is the opportunity now for Uber? $40 billion seems. Why should it be $100 billion?
I think if you take the point of view it's a commodity service and that it's, look, I have a lot of respect for Peter Thiel. I think he views it as a commodity service, that it doesn't really have powerful network effects. It may have local network effects. It's a street fight for every single city that you go into. I think if you take that point of view, then maybe it is overvalued. But you can also take the point of view that their traction has shown that they have some secret playbook that they've been able to go into markets where others have been dominant and out-execute them. And then you start thinking maybe they will have a global brand and a global network, which then allows you to think about all sorts of other things that could happen. This could transform transportation, it could transform logistics. That's the dream scenario. And I don't know where the ultimate sort of end game will come out. I certainly hope for Uber that they're successful. I would just point out that there are a lot of companies that you could write off as commodity companies, but they have figured out a playbook that no one else has in the past. And e-commerce is one of those areas. I think you have Amazon that is worth multiple hundreds of billions now. That you could have said it's a book business, or it's just it's in a competitive market. It's a low sort of commodity value by moving product from point A to point B, taking orders on one side, getting suppliers' inventory, and then sending it out. It is a competitive market. It's not a 0 to 1 sort of company as Peter Thiel would call it, in my opinion. And so does that make it not a good investment? If it turns out to be so competitive that you can't establish market leadership, maybe it's not a good investment. But Amazon was able to figure out market leadership. Uber seems to be figuring out market leadership, at least in the United States. Jury's still out whether they can be globally dominant, and so we'll see.
Well, I want to ask you questions about Airbnb too, because you're on the board and you're an investor. Since the $7 million Series A, Sequoia invested back in 2010 in Airbnb.
Yeah.
In Airbnb. Oh, well, that's right, the $600,000 seed round as well in 2009. But I also want to mention that we are taking questions as well. So do we have the microphones over there? So if anybody wants to ask a question, please feel free to just walk up to those mics. They're on the side of the side on the aisles. So I want to ask you a question. I don't know if, I'm sure a lot of people here read Mike Moritz's essay, your partner at Sequoia. He wrote an essay about subprime unicorns, and he basically said that investors, they're basically, these prices are illusory. They are basically, the investors are, what did he say exactly? I will tell you. He says that investors have structured their investments as debt in all but name, meaning they still stand to profit if the company is far less. So I'm assuming he's referring to liquidation preferences. And just wondering, is this a warning sign to entrepreneurs out there? Are they sitting down with investors and just demanding higher valuations and not understanding that at the end of the day, the VCs call the shots when it comes to the terms, and they may not be that good for them?
Well, I don't know if we call the shots because entrepreneurs are demanding higher and higher valuations. On what Michael was talking about, his notion, basically he calls it's structured almost like debt, and it's only in equity only, is his notion of multiples of liquidation preferences or ratchets. And I think most people would advise entrepreneurs to avoid those. And I think the reason to avoid those is it's in an unfair situation, because as an entrepreneur, you raise money, I don't know, let's call it 3 or 4 or 5 times in your company's life. And maybe you're a part of 3 or 4 companies, and so maybe that's 10 times in your lifetime. That's not a lot of experience on dealing with things like ratchets or liquidation preferences. And so to the extent you want to just play plain vanilla, just ask for clean terms and let the market price the valuation. To the extent you don't think that that's the right value for the company, and you think you have more information and therefore you think there's more upside to your company than the market is giving you, yes, entrepreneurs have asked that we give them a higher valuation in exchange for downside protection. And I think the unfairness of that is investors have done this more times than you have, and they probably understand the downside better than you do. And so my advice to entrepreneurs is if you're going to entertain that because you want the headline number of whatever number the valuation is, that you really think about the downside and what happens in the downside. And truth to be told, Zappos is one of those companies where we actually took a liquidation preference that's more than 1x on purpose, because we wanted to leverage that liquidation, the valuation, and we believed in the company so much that we could leverage the higher valuation to get more debt financing for the company. And so there are good reasons to do that. And in the end, it was very interesting when we did the analysis, because Tony and I went back to the emails. The deal that Sequoia would have given us on plain terms basically ended up being about the same as the terms with the higher liquidation preference with the higher valuation.
You were able to attract more. You wanted the high valuation to attract other investors. I mean,
we were using the higher valuation to attract debt investors. So
okay.
we raised a fair amount of debt to finance the company as well.
But today it's even tougher. I mean, these entrepreneurs are hearing these markdowns by like Fidelity, so they're getting a high valuation, but now they're stuck with terms that aren't so favorable, and potentially they could see their valuations marked down.
Yeah, but you can also look at it on the flip side. They raised a large round at a high valuation, and they have the cash. So.
Okay, and so you're saying that if you truly believe in your company, then great, go for the high valuation, get the 1x liquidation preference. That's common though, right? 1x is pretty common.
I think most entrepreneurs obviously believe in their company, so their natural inclination is to ask for the higher valuation with these terms. But my counsel is to really understand what happens in the downside scenario of those terms. It also puts the one
What
thing
happens in the downside scenario?
Well, if it's a ratchet, the next round, a full ratchet means that all the stock that you raise at a high valuation gets repriced to the lower valuation. So you really didn't raise money at the higher valuation. So I think you just have to understand the downside. And the downside is, if you have let's just call it just an extreme case. If you had an investor who have a 3x liquidation preference, or 4x liquidation preference on your company, the day they invest in their company, they would make 4x. The next day, they would make 4x if they liquidated the company. Guaranteed. So they're not actually on your side to help you build a company for the long run unless they could dramatically overcome the 4x. And so I think that's something you just really have to consider very carefully.
Yeah. Does anyone have any questions? I don't see anybody walking up to those microphones. I mean, this is a great opportunity to ask Alfred a question. He's been a 3-time, 4-time entrepreneur, has sold all of his companies. I'm sorry, they didn't sell them. They were acquired for several $100 million, including Zappos for $1.2 billion. Now he's a successful investor. There's one person right there. Is that a question?
Yeah, sure. I just wanted to ask, since you did invest in Airbnb, what did you see there about the future vision for Because they both seem sort of early on, like small markets.
I think we can't, so I wasn't at the firm when we invested in Airbnb. I joined a little later, but Airbnb, I think if you ask the partnership, they would have said that they came with a much more prepared mind because they had been looking at the vacation rental market for a lot longer and seeing how that would work. Airbnb also has this interesting sort of phenomenon that most people don't talk about. It is one of the rare global network effects companies in commerce. And so that was something that we got our minds around as a proprietary defensible thing and advantage. And one of the things that we always look for in a company that we invest in is some form of proprietary advantage that allows you to win. And they could be technology advantages, they could be network effects, it could be a disruptive business model. And it had both a disruptive business model and a network effect, and bring the technology to bear on a service like a bed and breakfast, which lots more people than you might think would use, was very interesting to the firm.
So on that note, Airbnb has incredible network effects. It has a very unique inventory, unlike, let's say, maybe Uber, which is just simply cars. Why? And I don't know how they're doing financially, but why is it valued at $25 billion and Uber is 50% more?
I don't know. I don't invest at those valuations, so you should ask the people who do.
But you've invested in in all the rounds for Airbnb, haven't you?
Sure, we invest in all the rounds. I don't know if it's as easy to explain valuations to rationally, but I think Airbnb will continue to grow at a nice pace. It's a little harder in Airbnb's case to buy supply than just can't buy supply. I'm like, hey,
yeah.
Can we rent out your room? It's a lot harder to do that than to get people to drive their cars. So the growth rates are very healthy. I don't think they've disclosed what the growth rates are, but they're not growing as quickly as Uber.
Well, I wanted, the Uber and, you're an investor in Airbnb, DoorDash, Instacart, these are all part of the sharing economy, so I want to ask you a question about how do you think about the newer opportunities in the sharing economy, but we have a question right there.
Alfred, you were asked earlier about whether this is a good time to start a new fund, and you said, hey, maybe it's not the best year or two, but if you're in it for the long haul, you might as well get going. If someone were going to get going right now, in this environment, 300 micro VC, seed stage, post-seed stage firms, what would make a new fund look differentiated? What would help it stand out from 300 others? What's the raison d'etre for someone starting out?
Well, I think if you were to ask potential LPs that invest in the seed funds, I think they would just sort of want to know, since there are so many of them, what's your unique proprietary advantage? Just like we ask companies, what's your unique proprietary advantage? And if you can answer that well and crisply, or you have a sector that nobody else has looked at and you have real conviction on why that sector is going to take off, you're going to specialize in that sector, and you have real insights into that sector, I think people will still look to invest in that fund.
Thank you.
Thank you.
So back to that sharing economy question and just what you're looking at, and I know that's something that you're very involved in consumer, or is that's what you like anyway, that area. So when it comes to, and you can't say you don't like the sharing economy companies because you've invested in so many of them, but I know there are a lot of people here, a lot of entrepreneurs who like to think, who are trying to think about other opportunities, and so how do you think about that? And I know you need to think about it as a VC. I know you're also getting a lot of entrepreneurs who are just approaching you and just sharing their ideas, but what goes into your head to kind of figure out what the next opportunity is?
If you're asking what areas we are looking at, I wouldn't be a very good investor if I told everyone what I'm looking at right now. But the way I think about the sharing economy is how do you generate network effects and make it much more of a marketplace than just a bunch of people moving product around? And if you can answer that question, you've probably iterated into the business that makes a lot more sense and has a lot more proprietary advantage than just the quote-unquote sharing economy.
Well, I mean, but you don't have to specifically tell us what you're looking at, but I mean, can you, an industry perhaps, healthcare, education, are there...
I will tell you that one of the areas that baffles my mind that there's not more innovation, it has nothing to do with the sharing economy, but right this second, that if you look at the top apps in the App Store, all those companies have high LTVs, and therefore they can pay their way to being in the top apps. Almost all of them. They're either,
They can pay their way to be a top app?
They can pay their way into the top apps because the people who are up there they have high LTVs. Lots of gaming companies have high LTVs, casino slot games have high LTVs, the entertainment apps have high LTVs. And so the question for the entrepreneurial community is, how do you figure out how to disrupt that? Because mobile distribution is now very, very hard for a startup. Almost every single startup cannot pay their way into it. So they need to figure out some viral hook, they need the engagement, they start to monetize, and then they could pay their way into it. But even then, it's a long ways off. So the question is, how do you create a mobile distribution network that is much more powerful than the current system? And I think that's a very, very interesting vein to sort of look at.
So is this an area you'd be interested in
It's an area
investing
that I think we'd be interested in investing in. It's an area that I think lots of our companies would actually use. It's an area that I think can benefit all sides right now.
So a distribution platform for mobile apps. Okay. It's not really the sharing economy, but it's an idea. Okay, I think there's a question over there.
Hi, thank you. I run a drone startup, and I was wondering how you view this type of space being cross powers and really with these other.
Sorry, I can't. Can you speak more into the mic?
Yeah. So I run a drone startup here in the Valley, and I have a question regarding your thesis and how do you view these types of opportunities when you have a hardware play and you also have an environmental regulation is affecting the pace of growth?
Something about regulation?
Well, so I think there are two separate questions. I think on hardware, how do we view hardware? Well, if it's just hardware, unless you have the margins up front, it's generally not a hard business. So we shy away of just hardware companies unless there's some ability to provide software or services on top and to be able to charge for that. On regulation, that's more nuanced. I think obviously a lot of the companies that we've backed have challenged regulation to some degree. I think as a startup, you have to challenge regulation in a smart way, or you have to figure out a way around it. And obviously, companies like YouTube had some regulatory problems with copyright. They have to figure out a way to sort of get around it. Airbnb has regulatory issues that it has to go around. Uber has to, and then there's this question of whether those regulations get enforced or not. So in copyright, it gets enforced later. You have some time to figure it out. In Airbnb or Uber's case, it also got enforced later. If something is being enforced immediately upon you, it's generally a hard area to sort of get around, and it's not a rich area for you to sort of innovate around unless you figure out a way completely around it.
Great. Let's get this guy here so we can get two more questions.
Sure, sounds good. You were talking about LTV and sharing economies. So we're a sharing economy with a primarily kind of recurring model. We have 6 months of cohort data. So at what point do you see, like if people are paying $19 a month to the system, at what point do you see that like this is really something that's that you would take a look at to have a high LTV that competes with the rest of the businesses that you're talking about?
You have 9 months of data. That's more than enough. Send us the data.
So we have like 3% retention after 6 months, $19 a month. Like, is that something that like at what point do you say like, oh, this is high enough LTV when it's more that per model that's like kind of we're startups, so we have a relatively newer, you know.
Well, subscription businesses, we tend to see increasing, it's like negative churn. You want subscription businesses with negative churn, so that's, so I think the numbers are just different depending on, if it's a freemium service, that, 80% retention is amazing.
Okay, thank you. Question about if you've raised a round in the past, it didn't work out, you pivoted and you got into something that is working, stage-wise, when going back into the raised with like second Series A. What's your feeling on those kind of businesses? If the metrics are working, my sense from the markets is often we pay lip service to kind of hustle and getting out and making it work, but it seems to me that often it's easier to raise that round if you started again from scratch and not have the baggage of the cap table.
I think that's probably true, that it's easier to just start from scratch. People can get their head around that. It's a new company, it's a new business. They don't anchor to the wrong thing, which is all the sort of time that you spend doing the old business. If you pick the right investor, I also think they won't care. I think we've backed a number of companies where they're walking the woods for a period of time, they figured something out, and we invested in them. I think the challenge that you have to face with your founders and your board and your investors is, it's really a new Series A company, and you've already have a Series A. What are you going to do to the cap table to make it palatable for a new investor to come in? And if you don't have a good answer to that, I think it makes it very, very difficult, because then you're asking us to be the bad guy, and we're going to cram down other investors to make the cap table work. Like, you should have that conversation before going out and raising the investment.
Well, I think that's all we have time for. We have to wrap it up, but I think Alfred is sticking around, so let's give him a hand. Thank you, Alfred.